All right, guys, so thank you very much indeed for joining us in this video. I'm joined here by my good friend and fellow trader, Zach Meir, who has been a trader and analyst for many years. And Zach, in a few moments, is going to share his opinion on a very important chart, which I'm going to share with you. And Zach, the chart I want us to look at is this here, which has been in the news. In fact, we were just talking about this in this webinar today, about the yield curve turning negative. And essentially, we have an inverted yield curve. So essentially what we're looking at, guys, is by far the most scary chart in finance. That is no understatement, or overstatement, I should say. Bottom line is that whenever the spread between the 10-year interest rates minus the 3-month notes becomes negative, so when the spread becomes negative between the 10-year and the 3-month note, what we get is an inverted yield curve. And this has not happened since, well, it says over here since 2007, but actually we can see it happened back in 2006, okay? And then essentially got worse in 2007. And we all know what happened just after 2007. We had the major financial crash. We had the major financial crisis and the Great Recession. So as you can see here from this chart, we are now in the inverted yield, again, not happened since 2006, 2007. Now, right now, the news media, as Zach was saying to us in a few moments, the news media is saying to us, oh, you know what, this is a calamity, this is terrible nightmare. But I'm going to show you, actually, there's something that the news media have not actually mentioned, which is very important. What is that? Well, let me show you. You see, take a look at this chart, and I want Zach's opinion on this in a few moments. But here's the thing. You see, guys, this is whenever, look at this. This is the history of whenever the yield curve becomes negative, a classic signal of a recession. But this is very interesting. Notice the previous times in history when the yield curve becomes negative, right? So we can see the last time this signal occurred, 2006, 2007. But look when the recession actually started. Look at the gray column. The gray column is when the recession actually started, about 12 months to 18 months later. So what we have to remember, guys, is that just because the yield curve becomes negative, it does not mean that the markets have to crash and go into a bear market and to go to a recession. No, the recession actually happens usually 12 to 18 months after the yield curve becomes negative. Look at the previous one. In the year 2000, the yield curve became negative, like you can see here. But look when the recession started, about a year afterwards, in the year, I think it was 2001, 2002. Maybe Zach can correct me on this, I don't know. But look at this gray column. The recession started about a year or two later, about a year or so later. Look at the one in the 90s. The yield curve became negative towards the beginning of 1990, but look when the recession started. Now, I don't actually remember what year that was. It looks like it was 91, 92. Yeah, Zach, what's your take on this? But the point I'm trying to make here, Zach, is that maybe you disagree with me, maybe you agree with me, but it seems that the history shows us, the statistics shows us that just because the yield curve becomes negative does not mean automatically we're going to go into recession. It means we're about 18 months, maybe 12 to 18 months away from a recession, which means if we go to the next chart, yeah, so the next chart shows to us that in that case, if you look at the right-hand side, if this is us right now in 2019, that puts the recession period about 2021. Now, Zach, what's your take on this? Do you agree with me? Am I wrong? What do you think?
Well, I think it's very difficult to argue with that chart. I mean, that is absolutely, spot on in terms of the signal and then the fundamental recession that you have afterwards. Really, the only question here seems to be when rather than if, and how. Well, yeah, it's basically how much of a delay do you think we'll get this time? Whether it'll be quicker because a quicker fall into recession because we haven't had a recession for a long time, or it'll be worse than before because China looks like that may implode or whatever. I mean, there's various different factors, but basically it just seems to be a textbook repeat. If you're a technical analyst, you love this type of chart, and I suppose if you're a fundamental analyst, you love this chart. It's actually the perfect marriage between the two, isn't it?
Yeah. I mean, if we just take a look, for example, at the last time this signal occurred back in 2006, 2007, it took quite a while, didn't it, Zach? I mean, I want to ask you something. If you could go back in time, and you saw this back in 2006, 2007, would you be bearish on the market, on the stock market? Would you still be bullish on the stock market?
I would. Well, I didn't actually. 2006, I was quite sure that something very nasty was going to happen very soon.
Right.
And so, like, I sold my house in London, I sold my flat in London, and I did this. I took preventative measures. But the only thing that caught me out was that in that recession, that was the first time when interest rates were slashed to near zero.
Yeah.
And so that changed the picture. What would be interesting here is if we are going into recession, and clearly governments everywhere do not want to allow economies to go into recession anymore. In the old days, they would allow it, let's say.
Yeah.
In fact, they would raise interest rates to make it work. What ammunition they have now to either to prevent a recession happening with interest rates already so low.
Yeah, that's a good point. And again, guys, just to repeat our point earlier in the video, just because you're hearing in the media or in the news that the yield curve has become negative, again, it's a mistake to assume that automatically we're going to go into a recession. No, it just means a recession is going to happen, yes, but it's about a year, maybe about 18 months away. As you can see from the previous history, look, it took about 18 to 12 months before a recession kick-started. That means if the history repeats itself, then therefore we could be about 12 to 18 months away, maybe the year 2021, maybe the late 2020 is more likely for the recession to start. And again, in a separate video, we can talk about as to what preventative measures we can take. But I will say this, Zach is absolutely right. I mean, so if potentially we're going to start a recession by the year 2021, as we can see here in the next 12 to 18 months, then that could spell bad news for the property market. For example, this is the property market in London. I mean, as Zach was saying, maybe therefore, if a recession is only about 18 to 12 months away, it's by no means certain. But essentially, what this chart shows us over here, that the property market seems to be in a bubble. And this is quite a dangerous sign by the looks of it, as far as the London property market is concerned, and it seems to show that the property market in London, and certainly if you go into a recession, that could have major implications for the property market, not just in London, but I'll say the UK and also maybe other parts of Europe and the US as well. And also that will have significant consequences for Bitcoin as well. If we go into a recession in the next 12 to 18 months, that will have major consequences for Bitcoin and cryptocurrencies, which we'll cover in a separate video as well. Guys, make sure you check out our member video. We just finished doing a full discussion with Zach here this evening. We talked about the stock markets, we talked about Bitcoin, cryptos, gold. We talked about the major currencies. We talked about the charts of the major currencies and all the major markets, including the majority of the major markets, including Bitcoin and Litecoin, XRP, Ethereum. So make sure you check out our member videos for the rest of our discussion. Thank you very much.